Maya Bhandari, Director Global Strategy at Citigroup, joins us now. Maya, good morning. Thank you for joining us. Maya, all eyes are now on US Fed, and the US Federal Reserve comments may move markets and asset classes across the globe. What do you expect to hear from US Fed on Wednesday? And is there a threat of withdrawal of QE3 really real?
Well, no, you're quite right. The Fed has had a big impact on markets, especially in the rate space. If I can, I'll take that question in reverse and talk about what we think the Fed's going to do ultimately, and then what we expect this week. Now, a very core view of Citi's really for some time has been that the Fed is likely to withdraw some of its stimulus. We've been calling for September again for some time, and we're looking for QE to be withdrawn, if you like, or tapered in two phases. The first in September, with most of it coming, most of the tapering coming via treasuries, so probably carrying on with about 60 to 70 billion of purchases a month, and then in the first half of next year, a stopping of the QE program altogether. Now, really core to this view is that the U.S. economy has been pretty strong. I mean, if you like, it's a sign of a successful policy from the Fed rather than a weaker one. And Citi's looking for 5% nominal growth later this year and into next year, 3% real growth. And really, I think it's going to be very hard for Ben Bernanke to justify purchases at the current pace if indeed growth is that strong. Now, what do we expect this week? Well, I think this week we probably have a little bit more of the same. In other words, no real moves from the Fed. If anything, they'd probably try and calm markets down a little bit, we think. But our view is very much that by September this year, you are likely to see some tapering of this QE program from the Fed.
Maya, hi, morning. Emerging market currencies have been battered out of shape, largely due to the dollar strength, in addition to the domestic challenges that many of these economies face. Do you see these trends persisting, and would USD then regain its status of a safe haven asset?
Well, I'm not sure that's right, because really, I mean, yes, you're quite right that the dollar has been strong and EM currencies have been weak, but that's been much more of an EM story than a story in global currencies. So, for example, against G10 currencies, the dollar's been weaker, not stronger. And so our view is that really this reflects, if you like, EM weakness much more than it does dollar strength. And this is indeed something that we expect to continue. We put out our latest FX forecast on Friday last week, and a big theme in that was, G10 currencies doing better than EM. Now, why? I mean, I'd sort of point to two or three factors. The first is quite simply deteriorating fundamentals in emerging markets. Current account surpluses are disappearing quite fast, particularly in Asia. Deficits are rising, debt burdens are rising, growth is weaker, and I think, EM risk premium or asset markets, if you like, we may simply need to readjust to reflect these changed fundamentals. The second, I think, is that, a lot of EM policymakers, if you like, have been caught a little bit on the back foot, in as much as they've been trying very hard to deter rather than encourage capital inflows. And I think, we've had several measures in the last few weeks, Brazil, Indonesia, all trying in different ways to now encourage capital back, or certainly prevent excessive weakness in their currencies, and we're skeptical that succeeds. I think a third factor, if you like, that has driven EMFX weakness and is likely to continue to drive EMFX weakness is that, throughout the last 12 months, what we've seen in a search for yield is investors piling into EM local rates. And as, partly linked to what's happening in the US, partly linked to what's happening domestically, as these rates markets back up, and investors pull more and more money out of them, I think that sort of adds, if you like, to the weakness we're likely to see in EMFX.
Maya, were you surprised at all with the hawkish stance taken by Reserve Bank of India in the June meeting, because they have raised a red flag on inflation trends for months ahead? And now do you think there is a danger of rate hike in India? And what do you think we could see from Governor in the coming June policy?
Well, was I surprised by the fact that they didn't do anything? No, not really. I think that was what the consensus was looking for. That's what Citi was looking for, and that's what we got. Was I disappointed? Yes. I think, India has, growth has come off. Inflation's come off. and I think, there is room, if you like, for the central bank to ease. Now, of course, this is all complicated quite significantly in India by the fact that Governor Subbarao is leaving in September. So these are his last couple of meetings. Now, at Citi, we're looking for another 50 basis points of rate cuts this year. Some of those, of course, will come under Subbarao. But, I mean, I don't think surprised would be the word I'd use. Disappointed would probably be a better one. Now, do I think they'll hike? I certainly hope not, because I think India's cyclical position is very different to Indonesia's. It's got slowing growth and inflation that's slowing too. And I think really what India needs is lower interest rates, and I very much hope they don't follow the Bank of Indonesia.
So how worried are you then, Maya, about the Indian currency? Because there are conflicting camps around the INR. Some believe we're still overvalued on real basis, and the others don't rule a move beyond 60.
Well, yeah, there's a lot of different views on the Indian rupee. However, one thing I would quite strongly disagree with is that the rupee is overvalued in any context. I mean, in both real effective terms and nominal effective terms, the Indian rupee is nearly the cheapest it's been. So I don't think it's a valuation story. What I do think, some of the concerns we all have on the Indian rupee, just so you know, we're forecasting 57 to 58 for the next 12 months in dollar INR. Now, I think part of the concerns we have, and I think other people have, are that, India really is a twin deficit country in a region flush with surpluses, and EM currencies are likely, we think, to stay under pressure. And I guess what I'm saying is we don't really see India outperforming, if you like, in that environment. I mean, I suppose we're not forecasting 62, 63 because I think a lot is already in the price at 58, 59. And remember also that one of the points I mentioned a couple of moments ago, which is this outflows of foreign bond purchase, foreign investor flows from bond markets. This is, of course, not at all a theme in India because the bond market is very heavily owned by domestic investors. So India doesn't suffer quite the same dynamic as other EMs do, but I think 57, 58 is where we're likely to see dollar INR trading over the next year or so.